Good evening, members. Welcome to the study circle meeting on the recent gratuity law. The notification from the state of Karnataka has stirred up the whole understanding what we had, and that's why we are having this session where the experts are going to help us interpret and understand what it is. So, may I request our chairman to escort the speakers of the day, Mr. Aditya Kamath, Advocate CA Deepak Chopra and CA Mohan Lavi. We also have our SIRC chairperson, CA Geeta AB. I would request her also to be escorted. Hearty welcome to all of you. You must be wondering why three speakers. Three speakers are going to give each of them will be going to give their perspective on each different laws. So I request our chairman Pramod Aride to give the opening remarks.
Good evening, esteemed members, respected SIRC chairperson Geeta AB madam. She was on this occasion, and we said we had actually a study circle meeting, then which transformed into a seminar rather on the state new gratuity rules. So when she was there, I just said, since you are part of Bangalore branch, why don't you even join us for the today's seminar? When this new gratuity rules kicked in or made effective, I got a couple of calls from a lot of members saying that what are the intricacies with respect to the rules, and is the insurance rule mandatory? I said, boss, I am an accounting and auditing professional, so rather I would call an expert in this field. So when then I invited Mr. Advocate Aditya Kamath. Then after that, when the things were evolving and we had a discussion, I had a thought process, why not convert it into a 360-degree view? Then of course, the first thing what comes in, how do we account it? What happens when we account it? And how do we look into it in the accounting standard perspective? Then I immediately called up Mohan and he was very happy and eager to help and take this session and give the perspectives about the accounting aspects. And when we talk about accounting and the law, then immediately I get a call saying that what is this from income tax perspective? Will it be allowed, disallowed, how do we do it? So then I immediately called Deepak and said, why don't we do a 360-degree overview? After doing and hosting the seminar, I still feel that I left out something. What would be the intricacies on GST, on the input tax aspect of this tax? Of course, let's try to cover in the next newsletter. I've also discussed with a speaker who can at least give the write-up so that whatever learning we have today will be covered in the upcoming seminar. Without taking much of the time, I know everyone is very keen on listening to what does gratuity rules says, what is mandatory, what do we do. Of course, most of us have been here and there calling each and every one of us and trying to brainstorm this entire rules. And as I understand, these rules were there even 10 years back, and suddenly off late this was made effective overnight. So then when I understand that this was already there but we never paid attention to also. So now since it's effective and already, I think we are already late. I think the registration was supposed to happen probably 20 days back itself, and the deadline is overdue. Of course, we are clients always comes to us after doing the transaction. So I couldn't put this much before, so let's at least now let's get an insight of it. And of course, let's have a panel discussion also towards the end of the session to have each intricacies, and you can shoot your questions to the panelists. But without taking much of the time, I would like to hand over the dais to our secretary to introduce the speakers.
Thank you, Chairman. Like the way I said, mentioned, that we have 3 speakers. The first speaker of the day is Aditya Kamath, an advocate. He is a partner at BCP Associates LLP, leading labor law and employment law audits in their as well as legal advisory practices in the firm. With close to 20 years of experience, he specializes in labor and employment laws, contract and compliances. He brings his extensive expertise to his role. Additionally, he also holds the position of guest faculty at the National Law School of India University, recognized as India's top school, one of the top law schools in the country. Of course, he holds a master's degree in international law and business trade law. His primary areas of interest encompasses labor and employment laws, corporate law, international contracts, data privacy and space law. That's interesting, space law, yeah. Soon we will be having a session on that, who knows, with all the challenges what we are facing. Yeah. The next speaker is Deepak Chopra. CA Deepak Chopra is a well-known face to all of us. We know him very well and been in the institute for many of our programs. He is a fellow member of the Institute of Chartered Accountants and has graduated in Commerce from Bangalore University, qualified in the year 2011. He has a strong passion for direct taxes and has been regularly taking classes for students of the Company Secretary and Chartered Accountants course. He is a regular faculty of Bangalore branch for direct classes. He was also teaching the students of CA final. He is a resource person on direct tax matters at various forums. He has also been the faculty for the offices of Income Tax Department at the Direct Tax Regional Training Institute, Bangalore. Currently, he is serving as the chairman of Direct Tax Committee of KSTA. He is the founding partner of Deepak and Associates. The next speaker who will be addressing us is Mohan Lavi. So he is a qualified chartered accountant in 1918, who qualified in 1989. He has over 25 years experience in industry across various industries. He has worked in senior positions in finance, in manufacturing and software companies. He has over 6 years experience in practice, is currently a partner at KP Ram and Company Chartered Accountants, leads the India's and GST practice of the firm. He is author of many books. IFRS, India's key audit matters and other related topics are his favorite topics for authoring. He has spoken at various conferences in India and abroad on accounting standards, IFRS, Sarbanes-Oxley and GST, and he is also a faculty member with the Institute for their IFRS certification course and register value programs. His articles appear frequently, as all of us read this, in Hindu Business Line, Deccan Herald and Bombay Chartered Accountants Journal. So, thank you for accepting our invitation and I welcome all 3 of you. Thank you so much. First, Aditya will be taking the session and then we'll follow by. Over to you.
Good evening, and first and foremost, thank you to the organizers for the invitation to speak, and I share the best with some August people, so hopefully this is living up to people's standards. Karnataka Compulsory Gratuity Insurance Rules is what we're going to discuss today. I have an agenda for this, probably will hope, I'm not sure about Q&A, we might move that around, but hopefully next 30 to 40 minutes I'll try to cover as much of ground as I can. Give you a little bit of introduction to the Act and the rules, how they came about, what was the purpose, and then look into the nitty-gritties of the rules. So we start with the statutory provisions that actually come into gratuity. The most critical part is that it is an obligation. It initially came about as a reward. The purpose of having a gratuity act in India and abroad was to reward employees for service. But when it took a statutory form, it became a mandate. Every company had to provide for it. Long duration of service is the the criteria for payment of gratuity, and this cannot be taken away except for certain reasons, and that's an important aspect. The whole purpose of the introduction of a compulsory gratuity provision, this insurance provision, was because you can't take away gratuity from an employee. And when the amendment came about, it came about with the purpose that employers were evading this liability by either not existing or not having sufficient amount to pay out, and then an entire insolvency process had to be initiated to recover amounts like gratuity. So it was felt that a provision should be made where employers be compelled to take out insurance, and that was the backbone behind the amendment. Now, when you look at the mandate under the Act itself, it requires that you must have a scheme to provide for gratuity for employees who are working in factories, mines, oil fields, plantations, ports, railway companies, shops or other establishments. So this is the ambit of coverage. If you have anything that's not covered within these, the Act effectively does not apply to you. Very difficult to get out obviously of most of these because you're either a shop or a commercial establishment or a factory, but if you have another entity that's not, then the rules, for example, law firm, I'm sure a CA firm also is not covered under these, so therefore gratuity doesn't apply to you, but otherwise it applies to everybody else. Right? Now, there are two other exceptions, we look at that later also, but primarily the head count required under the Act is 10. Interestingly, the word used here is 10 employees. It is not like other statutes which uses the word, 10 persons. Unlike other statutes, it does not use the word worker or employee. So categorization of people into different cadres in order to avoid the applicability of this Act also is a virtual impossibility. If you have 10 persons employed in this Act, it would apply to you. And that 10 threshold is in a period of 12 months from the date on which a question arises about applicability. So even if you've come down below that threshold thereafter, any time thereafter, but you have had 10 persons employed, then effectively this Act will continue to apply irrespective of what your head count is as on that date. Once applied, can't be applied effectively. That's what the provisions of the Act require. So there have been some critical amendments to the Act, especially if you look at the amendments that we are concerned about. The first amendment that came about was to bring in definition of employee and who it would include. There were a few judgments around this, whether managers were to be included, not included. So post amendment, this covers everybody, managers, supervisors, even teachers were brought into the ambit through this amendment. So applicability for gratuity per se today it covers the entire organization, unless you fit within the bracket of the word employer, in which case gratuity doesn't apply to you, but if you're anywhere else within an organization, gratuity would apply. The other amendment was 2018, it upped the threshold to 20 lakhs, corresponding amendments were made to the Finance Act, Income Tax Act as well. And one critical one, which for some reason I don't see here, is the 87 amendment, which brought in the section 4A. Until then it did not, was not a part of the Act, but then it brought in that section 4A which mandated compulsory gratuity insurance. So until that point it wasn't there. But we'll look at section 4A in detail. But after that amendment, I think that's on the next slide. So if you look at this amendment of 87, it brought in the requirement of a compulsory gratuity insurance. But at that time, it was felt that the central government wasn't the right authority to decide whether it should apply or not. So the power was given to the appropriate government, which means if central government is your appropriate government, they could decide. Interestingly, till today, they have not made it compulsory. State governments, if they are your appropriate government, they can decide, and so far very few states have made it compulsory. We'll look at that as well. Now after this amendment, the state government had the power to notify if they were the appropriate government for any entity within their jurisdiction, then compulsory gratuity insurance would be a mandate, and they could notify that. That power came to them after 1987. Interestingly, before 87 itself, the Kerala government had notified compulsory gratuity insurance, but it was not under the Act because there was no power, they didn't have an enabling provision. But they brought out their own rules, not under the Gratuity Act, mandating that every employer must carry gratuity insurance. We do have some changes that are coming up, and I think this is important because the way we see it, the Social Security Code is going to be law soon. It's already passed both houses, President's assent is received. The only thing pending is the date of actual implementation. Now, why does the Social Security Code become important? Because it changes everything that has happened till date. It makes compulsory gratuity insurance the prerogative of the central government. So section 57 of the code says that no appropriate government anymore, central government will have the power to decide if compulsory gratuity insurance is required, and it shall also have the power to decide how this insurance has to be obtained or what has to be done in this regard. Now, if this comes out in the next 12 months, that's our estimate, that's likely, because we've been saying this since 2020, it's not come yet, but if it does come out then whatever we're discussing today may be moot. We might be sitting here awaiting fresh rules from the central government on how this is to apply. Right? And interestingly, this makes reference back to certain legislations like the IRDAI and the Insurance Act, and brings in insurance as a requirement under that section if the central government were to notify. So, like I said, all provisions then would be uniform across states. Today, one of the biggest issues we have is if you're a multi-state organization, what do you do? And multi-state organizations can be of different kinds, we'll come to that in a bit, but then what do you do is probably the largest question that we as a firm answered, apart from other granular questions, right? So all of these differences will be put to rest if we have one common set of rules that would apply to everybody, which is what the code facilitates. If it comes through, then that's what will happen. So this is some background in relation to gratuity insurance. Now coming to the subject at hand, even though in 87 that amendment was made and state governments were given the power, very few states actually went. In fact, there were just two states, Andhra Pradesh and now Karnataka. When Andhra Pradesh did it by virtue of the reorganization of those two states, Telangana also inherited compulsory insurance. But apart from this, no other state has notified rules or a mandate for compulsory gratuity insurance. Karnataka followed suit recently. January it was brought about, 10th of Jan, and they gave essentially companies 2 months to comply, 30 days for some, 60 days for some, we'll look at that. So we are effectively the third state in the country, apart from Kerala, because that's not under this act, that has made gratuity insurance compulsory. Automatically, this also means the amount of knowledge on this subject is very little. Courts have not decided any issues so far related to compulsory gratuity insurance. The work we have done in Telangana and Andhra Pradesh has shown that even their compliance today is less than 10%, and it's been 14 years since they've implemented it, right? So the issue is impossibility of compliance, and we'll come to why it's impossible to comply in a bit, but as these rules are in their current form, be it in Andhra Pradesh or in Karnataka, they're not easy to comply with. There is a bit of a struggle for employers, which is why the risk of non-compliance is something that they weigh in favor of compliance in this particular case. Now, if you look at these rules themselves, they were gazetted by the Karnataka government, and this was done in exercise of the powers that they have under Section 4A. These are known as the Karnataka Compulsory Gratuity Insurance Rules of 2024. It's just 8 rules in all. I think 4 forms that they have as annexures, and that is the entire depth of these rules. The following issues that we are going to look at: applicability, how do you comply, what is insurance, fund, trust, registration, what are the compliance requirements under these rules is what we look at. The most important thing is appropriate government, and this is not in the rules, it's in the act itself. So, do these rules apply to a company in Karnataka if you're going to examine? You start with the test of appropriate government. So if you see appropriate government, I've highlighted what is important. It says having branches in more than one state. So if you have branches in more than one state, then central government is the appropriate government and the Karnataka rules do not apply to you. Okay, so that is, I think, very clear. In any other case, it's the state government. Now this poses certain problems. right? While the definition is very clear and says that if you have establishments which have branches in any other state other than Karnataka, then central government is the appropriate government. The issue becomes, what is a branch? So we've had jurisprudence obviously on this. I'm sure as accountants and auditors, most of you have the identification of what a branch is. But if you take, for example, a factory, right? Can a factory have a branch? If you keep this two-way, I think I will not fall asleep. So please, if you could tell me, do you think a factory can actually have a branch?
No.
Right. So the ESIC, a few jurisprudence in relation to ESIC went all the way to the Supreme Court, and the question was whether a factory could technically have a branch in another state. So the court held that only if these two had linked production, then you could treat it as a branch. When you say linked production, one generates material that is used for production in the other, either one. Then we could possibly deem it to be a branch, but otherwise in no other situation could two factories be a branch. So if you have a company today which has factories in 5 states, including Karnataka, these rules apply to them. They cannot come under this whole, the exemption of saying we're a multi-state organization and therefore it will not apply. If I have subsidiaries in various states, do these rules apply to me? I am headquartered in Karnataka, I have subsidiaries in other states, would these rules apply? Yes?
Yes.
Right. So again, very difficult to come under this exemption to say that a subsidiary is a branch. Right. So only truly if you have what is a branch, which means no independent existence, dependency on the parent branch or the head office for its existence, can you justify that you are a multi-state organization with branches in other states, and therefore these rules should not apply. Erring on the side of caution, most companies want to now say, unless we can clearly establish that we have a branch, we want to comply with these rules, right? So from that perspective, the way the law looks at it is, unless you're clearly within that exemption, it's really going to be hard for you to say these rules don't apply to you. I think we've discussed all of this. Subsidiaries, these are not branches. I'm not going to go into that. Right. So how do you check applicability? So I have a filter that you can run. Your first filter is going to be by looking at section 1.3, which talks about who it applies to. This is factory, mine, plantation in Karnataka. So unequivocally, if you have a factory, mine or plantation in Karnataka, irrespective of branches or otherwise, this applies to you. Your second test is if you have a shop or commercial establishment, then you have to have more than 10 employees. So your 10 employee threshold does not apply to factory, mine, plantation, only applies to shops or commercial establishments. And your next level of test under 2A is only for shops, commercial establishments. You check if you have branches in other states or not. If you don't have branches in other states, then these rules apply to you. Now what do you do or what do you require under these rules? I'm not going to read out rule by rule or walk you through. I'm just going to look at what these rules require of a company, right? So first, if as on date, which is on 10th of Jan, if you did not have a gratuity fund or insurance policy in place, what is it that you need to do? First, you have to examine if these rules apply to you or not. Second, you have to see if you're a new establishment or an old establishment. A new establishment is an establishment that comes into existence after 10th of Jan. So anytime between 10th of Jan and today, if you've come into existence, your compliance window is only 30 days. Within 30 days, you need to obtain insurance or set up a fund. This is relatively easy because your employees are new, nobody has accumulated continuous service, therefore you don't have any liabilities on your books in terms of gratuity already payable. So it's simpler to get technically an insurance or set up a trust fund. If you're an old organization, they gave you 60 days to comply. That 60 days to comply effectively ended on 10th of March. Right? Within that period of 60 days, you had a choice of either getting an insurance for gratuity, for your entire liability under gratuity, or setting up a fund and a trust for gratuity. Those were the two options given to companies who are already in existence as on 10th of Jan. Now, if your headcount was more than 500, the rules seem to indicate that if your headcount is more than 500, you have the option of setting up a trust. However, practically, the department's understanding is that 500 threshold is not written in stone, which means even if you are 10 employees, you can set up a trust. They are all right with you doing that and proceeding on that basis. So this is practically on ground. They are not challenging the headcount. They are saying any headcount, you set up a trust, we are all right. Now once you've done this, either acquired that insurance policy or set up your own trust, you are required then to furnish a registration with the department, and that happens in a form which is provided. And if you look at the form, interestingly, it requires you to provide the number of employees who are covered and the extent of coverage by virtue of saying, giving them the joining date of the employee. So by doing that, you effectively give the department information of how much liability you have and what kind of cover you've taken for that liability. Now once you've done that, there's also compliance requirements in terms of payment of the premiums before time, ensuring that that information is passed on to the department. Those are the compliance requirements that you have to do once you've obtained and gone through all of this. 15 days of renewal, within that time period, they're requiring you to file these returns. So this is for compliance of an organization that does not have either a fund or a policy as of 10th of Jan. Now if you did have a fund or you had a policy as on 10th of Jan, there are compliance requirements for you too. First, again, you will examine if these rules apply to you or not. Second, you have to ensure that your fund is an approved fund, or if you obtained a policy, you obtained it from an approved insurer. The second part is easy. Obviously, you would have gone to someone who is approved or licensed, but the first part is a little tricky because a lot of organizations did have funds that were not necessarily approved. Now, what is an approved fund? If you look at the rules, Rule 7 makes it clear that this is a fund which is approved by the income tax department. No other fund can be treated as an approved fund. So, approved by the income tax department, I believe, again, I'm not getting into tax, you will handle that, but if you followed the process required under the Act and you've gotten an approved fund, then they will deem it as approved. Now, again, there's a lot of grey area here because the income tax department has certain requirements for a trust to be approved by them, a trust and a fund, right? So the rules set out requirements which have a higher threshold. Now typically in law, when you have two laws that are at opposite ends and we find there's a conflict, the courts tend to take the higher threshold. Now what is this higher threshold? In the rules it says you must have a minimum of 5 trustees, and it says you must also have employee representation amongst those 5 trustees. So most trusts that exist today as on date, that is as on 10, would not have this kind of a composition because seldom does an employer ask an employee to be a trustee, right? Especially for such things. So how do you, now is that a non-compliance or not? So this is a complete grey area today. What we are telling companies is if you already have a trust, don't go into composition, simply register. If they accept it, which is what is happening, they accept and approve, you're good. Don't bother about changing the composition of your trust because you've gotten approval from the income tax department for the purpose of the labor department, that should suffice. But it is grey. We don't know if they'll rake this up in the future saying that the composition doesn't match what we have said. Okay. So once you have that fund in place, then you can go ahead and you have to, now again, approved fund without a trust is not possible under the Income Tax Act, therefore it's not possible under these rules also. We had questions on whether your trust should be registered or unregistered. Any ideas? Can I have an unregistered approved trust?
No.
So I don't have an answer, quite honestly, because we do have unregistered approved trusts. Because one is governed under the Trust Act, the Income Tax Department doesn't, what I hear, and I may be wrong, doesn't necessarily insist that you have to be registered under the Trust Act. If you have a registration as a trust, if I'm wrong, I'll be corrected hopefully, and you should be good to go forward. So they are not under the rules saying that you should be a registered trust or unregistered trust, but they are saying you should have followed the process under the Trust Act, which then says effectively you come back to saying you have to be registered under the Trust Act also under the rules. So Again, we have grey. You've already got an approved trust, which is not a registered trust. Now what do? You go ahead and register it because the rules require. Again, we've advised, go ahead, file the form, don't look at registering it now. File the form. If you get anything back in terms of objections from the department, then you can consider what to do. Right, so thereafter, trust and fund both are irrevocable. Once you've created them, that money can't be used for anything else, obviously that's clear. More importantly, the trust also cannot be revoked. Now, why is this a challenge? So we've had a lot of large companies which are holding companies that have created trusts. And they've created trusts for multiple subsidiaries, typically one trust covering all those subsidiaries. Now, if I want, for example, to have my entire corporate structure redone, I don't want to be in this holding and one parent form. What happens to this trust if it's an irrevocable trust? That question again is unanswered, because I might want to have an individual trust for each of my entities and dissolve my parent trust. Effectively, these rules don't allow for it. It becomes an irrevocable trust, which means you have to continue with its existence. Right? That's a little concerning as well. All contributions to the fund, trust or policy have to be made only by the employer. There can be no employee contribution, so no deductions. We have noticed that some employers tend to have a gratuity component within the CTC, right? And you don't pay that to the employee. So can it be argued that effectively it's a deduction? You show me a structure for my wage in which you've shown gratuity 4.83% on a monthly basis. You show it as gratuity, but I never received that money. Does it amount to a deduction? You're not showing it in your deductions column, but effectively should I not be getting that money?
No, it is not a deduction.
And the reasoning?
Reasoning, it is a cost to the company which I am showing it, and if the employee serves for 5 years, then I am liable to pay that. Whether he serves 5 years or not, by provisioning I have to create.
You're presuming that you've put that language into the contract to say only if you've completed 5 years you are eligible to receive this sum. Employment contracts may not have that language. Because a lot of this is cut copy paste, right? I get it from another previous someone's appointment letter and now it's in my company's appointment letters, right?
So at least if I say that you are liable for the gratuity as per Gratuity Act, would that cover my...
Yes, as long as you say you are entitled to receive gratuity if you are eligible under the Payment of Gratuity Act, you're fine. But the problem with not saying that in as many words and also showing it in a CTC structure, if an employee challenges, say, especially when you have a policy or you have a fund, that your contributions to that fund are going out of what I should be earning. Because CTC is not a defined concept anywhere. Right? I don't know of any labor legislations that define CTC. Pretty sure no other legislation in the country today talks about what CTC is. Is it an actual receivable? Or is it merely the cost to the company? That debate. But what I am trying to highlight here is, since you cannot deduct and remit from the employee, showing it has to be with that caveat that this is merely indicative of what my cost is. It has nothing to do with what your remuneration is. That clarity should be brought about. What do these rules require? It requires that you should obtain an insurance. It uses the word insurance under Rule 3 from LIC or any other insurer who is licensed under IRDAI to provide specifically gratuity insurance. So it's not an insurer who is licensed to do anything else. They might be licensed to provide life insurance, general insurance, but they need to be licensed to provide gratuity insurance. Now, when we did our homework, we found about 5 insurers that had, at least on their websites, because IRDAI doesn't have a list of insurers who are licensed for gratuity insurance. We could not find that information. But we have insurers who claim that they're licensed to provide a policy on insurance. They call it a scheme, a gratuity, group gratuity scheme, right? So first requirement itself is to obtain insurance. Now, when we say insurance, there are also products which give you insurance upon death of an employee, right? It's in the form of life insurance. It covers the Payment of Gratuity Act also. So but it is still life insurance. Is that compliance with these rules? So the answer to that question is no, because the rule specifically states that the insurance is to be for the liability to pay gratuity for all eligible employees. When you say all eligible employees, you're not restricting it to in the occurrence of a death. You're also including any employee who completes that 4 years, depending on how many days you're working in the week, either 8 months or 6 months, and then has a claim for gratuity because he's an eligible employee under these rules. So it has to cover him as well. So when you say it has to cover him as well, you're bringing in all past liability of the organization to pay. Your insurance policy has to cover that entire liability. As on today, no such insurance exists. And I'm stressing on the word insurance. And the reason I say that is the definition of insurance itself requires the insurer to undertake a risk. That risk being your loss, to make good a loss suffered by you. It is a contract of indemnity which requires that I indemnify you against a loss. What insurance companies are offering today are merely fund management schemes. Your entire liability has to be paid to them. They will then manage it for you. So technically speaking, it is not an insurance. And it is not what 4A was envisioned to provide. 4A was specifically envisioned to provide an insurance, which means the risk of the employer disappearing has to be covered by the insurer. That risk is not covered today by insurance companies. We filed a writ in the High Court. We're hoping that we get a stay on this matter on the grounds that it's an impossibility of performance today. You're asking me to do something that I cannot do. These rules are saying insurance, but you're saying fully funded, which means it's no longer insurance. Okay? That's a requirement. Now, who is liable to pay this gratuity? Again, here practices vary. Most companies that we deal with tend to pay gratuity out of their own books. They don't go back necessarily to the fund provider and say you pay the gratuity amount. Either they pay it and say you pay it back to me, to the company itself, or they pay and don't claim because their policies are not fully funded. They're truly treating it like an insurance policy. So that's going to have to change because this liability is now jointly and severally put in the rules, which means first liability is on the company to ensure that the insurer pays. And upon failure of the insurer to pay, company is still going to be liable to make good this payment. You also have situations where the controlling authority can take gratuity and pay it to the employee from the insurer. This is wherever there is a dispute as to the amount of gratuity or in cases where that comes into question. Now, how do you determine contribution? The rules go back to actuarial evaluation and say that that must be the basis. Accounting standards, I think you're going to address that. It talks about how you have to determine what has to be paid, or rather what is the liability that you have to cover. Secondly, it talks about the coverage of all employees within the company, and that the extent of coverage has to be 100%. Now, the issue with this 100% liability is when does gratuity become liable to be paid? Completing a certain term. So, while you can take the argument that technically it only gets, it's payable upon 5 years, which will break down, but it's also payable upon death irrespective of whether you've completed 5 years or not. So, technically it becomes payable from day one. Day one when an employee joins, it becomes payable. So, how do insurance companies compute premium? It's typically on an annual basis. They're not going to come to you every month or every week or ask for you to continuously pay. So that coverage has to extend to every employee who joins you during that period of 1 year also. And your filings with the department have to include that as well. So again, here compliance becomes an issue because every new joiner you're going to have to intimate the department that he is also covered and my gratuity plan covers him as well. Insurer also has to tell you that yes, all of these employees are also covered. So that's also going to be a little bit of a tedious task. Now, you will also see that what happens to unclaimed gratuity. So a large component of gratuity today for most companies remains unclaimed because people don't complete the necessary tenure. So how is this to be adjusted, right? I'm not talking from a taxation standpoint or an accounting standpoint, but from the insurer standpoint, how is he adjusting it against your premium? What LIC indicated to us was that they would correspondingly reduce premium if that happened. However, are they factoring in the earnings of the fund also? So if they are factoring in the earnings of the fund and reductions due to employees who have left without having a claim, then reasonably, it's a balanced system. But otherwise, it's not going to be a balanced system. You're always going to have much more in this fund than you're ever going to have to pay. Okay. Now, as of the fund itself and how it should be constituted, our interpretation was that 500 plus employees who could contribute, you could actually create this fund. The department has taken another view that you don't have to do it. In fact, the view the department has taken today, this is the Labour Department, is that it is mandatory to constitute a fund. Because no insurance is available in the market, they have taken the interpretation that you have to constitute this fund, you have to constitute a trust, and only then can you be compliant with these rules. So that's the interpretation that they have taken. Everybody who's approaching them, that's what they're saying. Again, we said all eligible employees to be covered. If you look at the fund itself, it's an irrevocable fund. It talks about contribution of 8.33% of the annual basic NDA, which is your liability. And it says that such contribution of up to 8.33% shall be tax exempt. Now looking at the trust itself, if you already have a trust and that's registered, then you're good. If you don't have a trust, then you need 5 trustees, employer-employee representatives are to be appointed. How is this to be managed? It could be managed either by the trustees or by an insurance company, and they've clearly stated that accounting standards 15 would apply to the trust in terms of accounting. So as far as registration goes, the process required for registration is that if you neither have insurance nor have a fund as on 10th of January, then you needed to get that in place, and by 10th of March you needed to file, 10th of March, and if you have, then before 10th of April you needed to file Form 1. So 30 days, 60 days was given. So 60 days was to obtain the insurance, and 30 days was to actually file the form. So 60 days you obtain, within 30 days after obtaining you file Form 1. If you already had insurance or you already had a fund, then you had the option of filing Form 2 before 10th of March, provided you had full coverage of all employees. These were the registration requirements. Compliance is extremely low. We haven't had too many companies comply with these requirements. I think most important, what happens if you don't comply? So the cost of non-compliance under the Act is set forth to be 10,000 rupees as the penalty, plus 1,000 rupees for each day of non-compliance. In addition, there is also a blanket punishment under Section 9, which talks about 3 months of imprisonment, which could extend up to 1 year, 10,000 rupees fine, which could extend up to 20,000 rupees. So this is for non-contravention of any provision of the Gratuity Act. Application of Section 9 is hard, but 4 is easy. For hard, you have to, when I say hard, I mean for Section 9 to apply, you actually have to show that there is intent or mens rea, only then could I bring in these imprisonment provisions, that's why it's going to be hard. But this is your cost of non-compliance. There's also a challenge in true compliance. I was talking about what is insurance and what is available in the market. It's also a huge upfront capital for companies that have not really, they only showed this in books and not really set the money aside. For them it's a huge amount of money to come up with in a period of 2 months at the end of your financial year. So that is the biggest challenge that most companies have come to us with, saying, where do we bring this money from? We've had employees with tenure of up to 20 years. We know they're not going to leave for the next 10 years. Why should I account for it and pay for it today itself? That's a huge challenge that they've brought. Like I said, this is not in the banks. Most of this money is only on books, and therefore that is the challenge that we have. So with that, I think I come to an end. I think we'll take the other sessions before Q&A. Or yeah? Thank you.
Good evening all. So I have been tasked with discussion on taxation aspects of gratuity. Now, before we begin with issues in taxation of gratuity, I wish to express my gratitude to the branch, the organizers, for having provided me this opportunity to present myself before you. The term gratuity is nowhere defined in the Act. In normal English, in common sense, gratuity is understood to mean something which is paid gratuitously, right? Something that is paid voluntarily out of free will without any charge, right? But post the session that we've had, we've already understood there is no free will here, there is no voluntary component of gratuity over here. It's a mandatory statutory payment that every company who's falling into those eligibility criteria has to comply with. Coming to the taxation aspects, I have been asked by the branch chairman to give a 360-degree view of taxation of gratuity. So we split our taxation into three buckets: taxation in the hands of the employee, taxation in the hands of the employer, and very briefly, taxation in the hands of the gratuity trust itself. Beginning with the easier one, that is taxation in the hands of the employee. In the hands of the employee, as we all know, gratuity is part of salary. It is salary by virtue of section 17. It is section 17 which tells us that salary for the purpose of 15 and 16 will include gratuity. So gratuity is taxable under the head income from salary. Now while it is taxable as salary, it is also exempt. Certain portions of it is also exempt under section 10(10) of the Act. We'll quickly run through this. This is something that we are all pretty aware of. So if the gratuity is received in the course of employment, then nothing of it is exempt, it is entirely taxable. If the gratuity is received at the time of retirement or upon death of the employee, then we have three branches to be looked at, three clauses, 10(10), clause 1, 2, 3. Clause 1 deals with an employee who is covered under the pension code, basically an employee who is working for the defence, for the central government, local authorities, etc. Such an employee receiving any amount of gratuity, the entire amount is fully exempt under 10 subsection 10 clause 1 of the Income Tax Act. If you are not a central government employee, not an employee falling under the pension code, then there are two possibilities. You received gratuity which is covered under the Gratuity Act of 1976 or which is not covered under the Gratuity Act of 1976. Now, if the gratuity received by the employee is something that is covered under the Payment of Gratuity Act 1976, then clause 2 of section 10 subsection 10 gives you an exemption to say the gratuity shall be exempt subject to a maximum of 20 lakh or the amount actually payable under the Gratuity Act. And the amount actually payable under the Gratuity Act is given to us by this formula, 15 days salary. So the formula is 15 by 26 into last drawn salary into number of completed years of service. If there is any fraction, it is to be rounded off. So let's say I have completed 11 years and 9 months of employment, then it will be rounded off to 12. If it is 11 years and say 3 months of employment, then it will be rounded off to 11. If I am a recipient of gratuity which is not covered under the Payment of Gratuity Act, then also I get an exemption under clause 3. So there the maximum that I can claim as exemption is 20 lakhs or again there is a formula given 15 by 30 into average of last 10 months salary into number of completed years of service. But there are some arithmetical differences between the computation that happens under clause 2 and clause 3. We will not get into too much detailing. For the purpose of counting the completed years of service, under clause 2 we do a rounding off, under clause 3 the fraction is ignored. So if I work for 11 years and 9 months and I am doing the computation under clause 3, that is a person not covered under the Payment of Gratuity Act, that 9-month period will have to be ignored and 11 is what will be taken in the formula. Right? Now, we will quickly deal with a bunch of issues surrounding this. Now, would this be available if, as an employee, I have opted for the new scheme, new taxation regime? Will I still get 10(10) exemption? Yes. The answer is yes. Answer is yes. 10(10) is available both under the new regime as well as the old regime. Now, there is also a proviso to 10(10) clause 3, which says the limit of 20 lakhs that you find under clause 3 is not a transaction limit. It is a lifetime limit. To help you understand with an example, let's say I am an employee retiring today and I receive 15 lakhs of gratuity, whole of which is exempt under 10 subsection 10 clause 3. Now 5 years later, I once again retire from another company and receive another 15 lakhs of gratuity. Now at the time of my second retirement, I will get not exemption up to 20 lakhs because up to 20, 15 is already being utilized, 15 is already being exhausted. Maximum that I can get at the time of my second employment, second retirement is only 5 lakhs. Now this lifetime restriction of 20 lakhs applies only to clause 3 and it will not apply to clause 2, something which has also been clarified to us by Bombay High Court in the case of NG Public's case. For clause 2 it is per transaction limit, for clause 3 it is a lifetime limit. We also have another interesting Bombay High Court judgment on this issue, the case of PM Mehra, wherein the court has told us for computing the number of completed years of service, you will not look at the current employment which is terminated, you will also look at the previous employments, provided the previous employment did not result in any gratuity benefit to you. So let's say I have retired today after 3 years of service, and then I go on to another employment, and after 5 years I retire from that employment as well and I receive some gratuity. Now for our formula under clause 2 and clause 3, the number of completed years of service is not going to be 5 years, it is going to be 8 years, is what Bombay High Court tells us. We quickly move on to taxation in the hands of employer, where we have slightly more issues as compared to what we saw under taxation in the hands of employee. Now for the purpose of tax allowability or deduction in the hands of the employer, we have a key provision 3615, right? That's what you see on the screen. Any sum paid by the assessee as an employer by way of contribution towards a approved gratuity fund created by him for the exclusive benefit of his employees under an irrevocable trust shall be allowed as deduction under 3615. Right? The key conditions here is contribution should be to a approved gratuity fund. What is approved gratuity fund? We'll look at it in a short while. The trust should be an irrevocable trust, and the trust should be formed for the exclusive benefit of the employees. If all these 3 conditions are satisfied, the contributions, the payments that I as an employer make to such a gratuity fund or a gratuity trust shall be tax deductible, shall be allowed as deduction in my hands in my income computation statement. What happens if I violate any of these conditions? Let's say I am making a contribution to a unapproved gratuity fund, or let's say I am making direct payments to my employees as and when they retire. Gratuity is directly discharged by me to my employee, or let's say mine is a case where there is only provision that is created and it is not backed by any fund. I have not invested the amount in any fund. In all these 3 scenarios, obviously you will not get a deduction under 3615, but then they say, जिसका कोई नहीं होता है उसका भगवान होता है, and under income from business, expenditure which does not fall under any of the deduction sections will fall under the residual section, section 37. Right? So section 37 will give you deduction for that, but then again, let's not jump to conclusion because all deductions are subject to test of disallowance provisions as well. We'll come to that also in a short while. But before that, let's quickly look at what the approved gratuity fund means. So 2(5) of Income Tax Act defines approved gratuity fund. It means a gratuity fund which has been and continues to be approved by Principal Chief Commissioner, Principal Commissioner or Commissioner in accordance with the rules contained in Part C of 4th Schedule. So Part C of 4th Schedule gives you a bunch of conditions and procedural requirements. We'll not get into all of it. We'll just look at the critical rules and critical provisions that we have in the Part C. Rule 3, conditions for approval. So we have in all 4 conditions. I'll quickly rush through these. Condition number 1, the trust should be an irrevocable trust and not less than 90% of the employees should be employed in India. That's your condition number 1. Number 2, the sole purpose of the trust should be payment of gratuity to the employees who fall as beneficiaries of the trust. Number 3, the contributor to the trust or to the fund should be the employer and nobody else. It is only and only the employer who can make contributions to the trust, and all the benefits granted by the fund shall be payable only in India. So the gratuity has to be paid out in India only. There are also restrictions with regards to the investment or utilization of the contributions received by the gratuity trust. Now, the money received by the trust can be parked either in post office savings bank account or a current account or a savings bank account maintained with a scheduled bank. You also have the option of making contributions under group gratuity scheme, what we just discussed in the previous session. You can have the scheme registered with LIC or any other insurance provider registered with IRDA. And the balance surplus, the surplus money that you have, or in the case where you want to manage your own fund, own trust, then the investments have to be made in accordance with Rule 67 Sub-Rule 2. There we have a list of investable securities, list of areas where, sectors where you can make investment. You can make investment in government securities, and that shall constitute minimum of 45% of your overall investment, subject to a maximum of 50%. Debt instruments, minimum 35, maximum 45. Short-term debt instruments up to 5%. Equities, minimum 5%, maximum of 15%. And then you can also make investments in asset-backed investments like mortgage securities, and there's some miscellaneous investments given to us in the rules, which is up to a maximum of 5%.
What is this balance surplus?
Balance surplus, basically if you're not going in for the gratuity scheme, you're not going in with a insurance provider, then if you want to do it by yourself and you are not happy with your funds lying in a current account or a savings bank account, then you can invest in any of these permitted modes of investment. 48.7 is critical for our discussion today. We'll give a slow, plain read of it and then we'll try to summarize it. 48.7, Clause A. Subject to the provisions of Clause B, no deduction shall be allowed in respect of any provision, whether called as such or by any other name, made by necessity for the payment of gratuity to his employees on their retirement or on termination of their employment for any reason. Clause B. Nothing in Clause A shall apply in relation to any provision made by necessity for the purpose of payment of a sum by way of any contribution towards an approved gratuity fund or for the purpose of payment of any gratuity that has become payable during the previous year. Now what 48.7 is basically trying to do is, it is telling us that any provision that you create in respect of a gratuity liability, we will disallow it under 48.7 Clause A. Right? So it is indicating that this expenditure towards gratuity shall be allowed as deduction, not on accrual basis but on cash system. So provisions shall be disallowed, it is only actual payments that shall be allowed. That is the sum and essence of Clause A. Clause B goes on to carve an exception to say, okay, Clause A will not apply to two kinds of provisions. A provision which is created for contribution to a approved gratuity fund, or a provision which is created for a liability that is actually accrued during the previous year. Right? Other than these two exceptions, all other provisions debited to the P&L account shall be disallowed for the purpose of income tax computation. Let's try to understand this with some simple examples. Right? So let's say Mr. X retires on 27 March 2024. Now the employer computes his gratuity at 15 lakhs and makes a provision in the financials for financial year 23-24. This gratuity is paid to Mr. X on 15th April 2024. Right? So the employee has retired in the month of March 24. His gratuity is computed, and on 31st March a provision is made in the books of account. The liability towards his gratuity, 15 lakhs, is recognized, the P&L is debited by 15 lakh. Now this 15 lakh is not paid in 23-24 but it is paid in the subsequent financial year, that is 24-25. The question here is, would any disallowance arise or no? Disallowance would not arise because this is one of the exceptions carved out under Clause B of 48.7. Likewise, if there is a provision for approved gratuity fund, for contribution to approved gratuity fund, Employer Limited makes provision for gratuity rupees 15 lakhs based on actual valuation, and the gratuity is contributed to an approved gratuity trust on 15th April 2024. Right? Again here, this is something which squarely fits into Clause B of 48.7. There is a provision for 23-24 financial year. I have only accounted for a liability. I have not made any actual payments. The actual payment is happening in the subsequent financial year. Yet there shall be no disallowance in my hands, and I shall be allowed deduction under 36.15 read with 48.7 Clause B. Third example. Employer makes a provision for gratuity rupees 15 lakh based on actual valuation. The liability is not backed by any planned asset and there is only a provision in the books, which is the classic case with most of our SSCs. So there is a provision which is recognized in accordance with the actuary's report, and that's it. The liability is sitting in my balance sheet and my P&L contains a hit of 15 lakh. Now this provision is what is going to be hit by 47 clause A. The entire 15 lakh will have to be disallowed for my income computation. A bunch of issues. X Limited has set up an approved gratuity trust, which in turn has subscribed to gratuity scheme of LIC, which is what typically our state government of Karnataka wants us to do. X Limited debited a provision of 50 lakhs in financial year 23-24 and in April 24 directly paid the said sum of 50 lakh to LIC. Again, this is what happens in most of the entities. There is a trust which is set up, but the trust bank account is mostly inoperative. Ideally, the funds should go from the company to the trust and from the trust to the insurance provider, but that is not what happens in a lot of cases. The company makes a direct payment to the insurance provider. Now, literally read, this is a contribution not made to approved gratuity fund, and there have been cases in the past wherein assessing officers have. If you can give it 10 minutes, I may. That's okay. So what should be the assessee's fate in this scenario? But thankfully, this was a very widely litigated matter earlier, which is now settled by Supreme Court. So earlier this was a Madras High Court judgment in the case of Texture, and now approved by Supreme Court in 2013 to say, see, look at the intent of what the provision requires you to do. You making a payment to the trust and trust making a payment to the service provider, that is the insurance provider, or the company making a direct payment on behalf of the trust to the insurance service provider should not lead to any disallowance, because the intent of the statute has been complied with, and in any case it is a payment on behalf of the trust. In the books you will still pass journal entries. Credit the trust and debit the trust at the time of payment, and it is as good as payment made by the trust, just that it is going out of the bank account of the company and not routed through the bank account of the trust. Supreme Court has said, not an issue, no disallowance to be attracted. 43B also has an implication in our today's discussion. 43B, as we all know, gives us a list of expenses, across A, B, C, D, E, F, G, H, about 7-8 expenses, which are allowed as deduction on cash system, irrespective of the method of accounting that you follow. So only in the year in which the expenditure is actually paid is the year in which you get the deduction, is what the main body of 43B tells us. However, the proviso goes on to give us a slight relaxation to say, okay, if you have not been able to make payment during the year, but if the payment is made before the due date for filing the return of income at a 139 month, which is 31st July, October or November as the case may be, if the payment is made before the due date for return of income, we will still allow it as deduction in the year in which the expenditure is incurred. Now, one of the items that you have in the list of expenses listed under the 43B is this contribution to a gratuity fund, right? So if we were to club 43B and 48.7 for our understanding, let's see if we can get this right. So 48.7, so if you have to recap, 48.7 told us no expenditure shall be allowed on provision basis. No deduction shall be allowed on provision basis. Only provisions for contribution to approved gratuity fund or provision for actual liability incurred during the year shall be allowed as deduction. Rest everything shall be disallowed. 43B further went on to add another condition to say, okay, the provision that you have made for contribution to approved gratuity fund shall be disallowed if the payment is not made before 31st of October or 30th of November as the case may be. So let's look at this. X retires on 27th March 2024. Employer Limited computes his gratuity at 15 lakhs and makes a provision in the financials for financial year 23-24. The gratuity is paid to Mr. X on 15th December 2024. Basically, this is a continuation of our previous example. Instead of 15th April, the payment is now made on 15th December. That is after the due date of, let's say, 30th November. That's the maximum that we have in the bank. So, would any disallowance be attracted here or no?
Yes.
Under 48.7, any disallowance is attracted? No. Because 48.7 clause B, this clearly fits in. Under 43B, would any disallowance attract?
Yes.
No, under 43B also disallowance would not attract, because 43B talks of only contributions to gratuity fund. It doesn't cover the second leg where I made a provision for actual liability. That is not covered under 43B. Only contributions, provision for contributions to approved gratuity fund is what is covered under 43B. So here we will not have a disallowance under 47. We will also not have a disallowance under 43B. Employer Limited made a provision for 15 lakh based on actual valuation. The gratuity is contributed to an approved gratuity fund or trust on 15 December 2024. Will we have a disallowance here? Yes, not under 47 but under 43B. So for the computation of income of financial year 23-24, 15 lakh will be added back. In 24-25, that is the year of payment, you will get a deduction for this 15 lakh. Continuing with the same example, example 2. Now if the contribution is made to an unapproved gratuity fund, instead of an approved gratuity fund, if it is made to an unapproved gratuity fund, would I have any consequence under 43B? No, I will not have to travel up till 43B because under 48(7) itself the entire provision is already disallowed. Right? I cannot have a double disallowance. I will disallow the entire provision for 15 lakh under 48(7) clause A. 43B will not have any application because 43B applies only where there is a claim for allowance. My claim for allowance is already disallowed under 48(7). So there is nothing left for me to disallow under 43B.
In the first case, return is filed on 30th September. How do that date is not paid? How do you number?
Because 43B talks of disallowance.
48(7).
48(7) clause B provides for an exception. 47 clause A tells you we will disallow all provisions for gratuity, but then clause B goes on to tell you if the provision is towards actual liability that you have incurred during the previous year, then we will not make a disallowance. So if the employee is retired on 27 March and I am due to pay him 15 lakh, in 23-24 that's an actual liability that I have incurred, which I am supposed to discharge in 23-24. I have paid it in the subsequent year, I have made a provision, it's all okay with 48(7) clause B.
But may not be the exact amount.
No, I would know. No, so by the end of the year, I would know. I would have done my FNF for all my employees. I would know the exact amount for sure. This I am referring to retirements or deaths which have happened during the year and for which I have a certain determined amount. Now, if I am a person who is making specific provisions for those amounts, I fall under 47 clause B. But if I am a person who is making a general provision based on an actual liability, then I don't fall under 47 clause B also. Okay, now talking of this third example, so in year 1, it will be disallowed, the 50 lakh will be disallowed under 48(7). Year 2, that is 24-25, the year in which I have made an actual contribution of 15 lakh. What would be the fate of that payment that I have made? Do I get any benefit, any deduction of that 15 lakh which I have contributed to an unapproved gratuity fund, but there is an actual outgo from my bank account? Do I get any benefit? Do I get any deduction? Year 1, it was only a provision entry, we have disallowed it under 48(7). Year 2, there is an actual outgo from my bank account. I have actually made a payment of 15 lakh to a gratuity fund, an unapproved gratuity fund. Do I get any benefit?
No.
Unapproved, no.
Unapproved is, see, 48(7) is talking of disallowances of only provisions. If there are actual payments, 48(7) has no role to play. I can go back to 48(7). If you look at the text of 48(7), no deduction shall be allowed in respect of any provision. It is only provisions which stand disallowed under 48(7). Actual payments are outside the ambit of 48(7). So what do I do with this 15 lakh which I paid in year 2?
It's allowed only when the unapproved fund pays it to the employee.
I get a claim under section 37, also upheld by Karnataka High Court in the case of Madras Tobacco Company. But then subsequent to that there have been amendments and we now have 48(9) in the statute. 48(9) tells us contributions to unapproved gratuity fund shall be disallowed. I hope this ties up the entire scheme of gratuity taxation. So if there is a provision for gratuity which is not towards an approved gratuity fund, I disallow it under 48(7). If there is an actual contribution, not a provision, if there is an actual contribution, but if the contribution is to an unapproved gratuity fund, that gets disallowed under 48(9). So let's summarize this. So, to my mind, these are the 4 possible scenarios which you can have with regards to gratuity. So there is a general provision made for gratuity, not backed by any asset, which is the most common case scenario. Now that general provision is going to get disallowed under 48(7), and you will be allowed deduction in the year of actual payment to the employee. The year in which the employee actually retires or dies and there is a payment, there is an actual outgo from your bank account, you will get a deduction for that. Now there is a provision for gratuity towards contribution to approved gratuity fund. There shall be no disallowance under 48(7), but you shall be subject to 43-week time limits. The contribution has to be made before 30th of September or 31st of October, as the case may be. Right? If there is a specific provision for gratuity liability that has become payable in the previous year, there shall be no disallowance under 48(7), and this is also not subject to the time constraints under 43B. You can make payment even after the due date for return of filing the return of income. 43B disallowance will not be applied. If the provision for gratuity is towards contribution of non-approved gratuity funds or investments, then you will suffer a disallowance. In the year of provision, you will suffer a disallowance under 48(7), and in the year of payment, you will suffer a disallowance under 48(9). I hope this is clear to all. In any case, we will also be taking up a separate plenary session. Taxation of gratuity trust, I will just quickly wind up, may not be of practical relevance to all of us over here, but then we will have a broad bird's eye view of it. Now 1025 clause 4 tells us that the income received by the trustee on behalf of the approved gratuity fund is fully exempt. Basically, income of approved gratuity fund is entirely exempt under 1025 clause 4. All incomes, everything, the contribution that you receive, the interest, the capital gain, the earnings that you make out of the investments, everything is, the entire income is fully exempt under 1025 clause 4. Now, what would be the tax status of this gratuity trust? Under what tax category do you file the return of the gratuity trust? It's going to be an AOP, Association of Person. And now, because this is an AOP where the shares of the beneficiaries is indeterminate, section 167B would be applicable. 167B talks of MMR. So the income of the trust would be chargeable to tax at maximum marginal rate. But then we just discussed the entire income is already exempt. So the rate of tax really makes no difference, something which is also acknowledged by CBDT in a circular of 1982. Let's not get into the controversy of what is the rate of tax applicable to a approved gratuity fund, because the entire income is anyways exempt. So there is no question of levying any tax. But for the same reason, we also have a circular of 2017 which says that on payments made to a approved gratuity fund, there shall be no TDS. There shall be no TDS, and because the income is unconditionally exempt, there is no condition attached. It's not that you have to maintain books, you have to get audit, you have to comply with certain conditions, you have to contribute 85%, nothing of it is applicable, and therefore approved gratuity fund is in fact also exempted from the provisions of mandatory return filing of income. There is no mandate on an approved gratuity fund to file, although it's advised and a good practice to file the return of income, but then non-filing will not attract any penal or other consequences. Now, if in case you choose to file a return, what would be the form? 4. No, sorry, 5. Not 4. It would be ITR 5. So this broadly sums up, I think, beyond this.
The first one, the 1025-4, that is the contribution made by the employer to the trust.
Anything, everything. Contribution anyways is a capital receipt. Even if you want to tax it under 56 to 10, 1025-4 would come to your rescue. At no point of time, under no scenario would you have any category of income taxable in the hands of a approved gratuity fund.
Any income.
It is unconditional, and in its entirety, the entire income is fully exempt. Right. So with this, we'll break for a tea, sir. We'll break for a tea and we'll assemble back for more Lavi sir's session on.
Non-filer latest things will not affect here. 3 years.
Will not affect because there is no TDS, no. There won't be TDS also. If there is TDS, then you will obviously go ahead and file it and claim your refund. Thank you.
We'll break for 15 minutes
and so first of all, let me thank Bangalore branch for calling me here to talk on probably one of the most boring topics. After hearing Aditya and the excitement of the notification and the excitement of taxation, I really don't have much to offer in terms of accounting standards, unfortunately. But that's why I did not do a PowerPoint. So I'll speak for about 10 or 15 minutes and then we'll open the floor up for questions. I think I'll have the liberty of saying that most of the questions will be to Aditya and to Deepak only. But of course, you can still direct questions to me also. One of the things which I observed in Aditya's presentation, I did go to through the notification also, was that they have given a reference to AS 15 only and no reference to Ind AS. Of course, I think Income Tax Department, GST Department, the department who issued this notification, do not consider Ind AS to be a set of accounting standards at all. It is only SEBI which considers an NCA.
India is out of country.
Out of country. They think it's still some foreign alien concept by bringing to India. So, they have not spoken about the Ind AS aspect. So, I mean, pretty much in terms, apart from presentation of actual gains and losses, AS 15 and Ind AS 19 are exactly similar. Apart from the presentation of the actual gains and losses, which in Ind AS will go to something called as other comprehensive income, but I said it will be a part of the profit and loss account itself. So this is one of the things which I thought I should bring forth, because presentation of those actual gains and losses would also change depending on which set of accounting standards or which framework of accounting standards you are applying. Now, Aditya also mentioned that the insurance premium will be calculated based on actual valuation, right? So here's my question to all of you. I'm sure in this audience, every one of you all have received an actual valuation report. I'm being very particular in my words here. All of you have received an actual valuation report, right? How many of you have understood it? So I think that response says it all. Because for us and for most of us, none of us is exempt from this. An actual valuation report is a report we should get only for the purpose of disclosure. What amount should I put in my P&L account? He gives a nice beautiful table which says fair value of plan assets, present value of gratuity liability, discounting rate, everything what we have given only. Please remember the inputs for the AB report are given by us only. He is doing something called as projected credit unit method, which nobody understands what it is. But since this 10th of January notification also says that your insurance premium will be based on the basis of your actual valuation, the provision which you are determining will also determine the amount of premium which you are going to pay. This is what I would assume is going to happen for most of the cases. So, in the case of funded and unfunded gratuity liabilities, as Deepak was saying, apart from a certain set of our clients who got more than 500, they have a trust, they are consolidating the trust, those are separate set of clients. Most of our other clients are provision tane, entry madbana. Deepak will disallow it anyhow for income tax. So it's already reckoned for the purpose of my taxation benefit there or taxation non-benefit, so to speak. In the case of these unfunded trusts, this gratuity provision, and I'm leaving apart the taxation aspect here, will come and sit as a provision in my books of account. In the case of a funded trust, apart from your actual gains and losses, the difference which goes to your other comprehensive income, and it will never recycle back into the profit or loss account. It will remain in your profit or loss account, it will probably go as an expenditure. But in the case of a funded trust, the disclosure requirements and a few of the accounting requirements would require a little bit of detailing. The gratuity liability in any actual valuation report, be it AS 15 or Ind AS 19, would be on the basis of present value of defined benefit obligation. It's called a defined benefit obligation. We use a nice term. In India, we use it as gratuity. There they say defined contribution plan is PF, defined benefit plan is gratuity. He will look at the estimated length of service of the employees, present, how many people are actually working right now, what is the increment, what is the possible attrition rate, and give you one number. Discounted present value of liability for gratuity for 31st March 2024. In case you have got plan assets, in case it's a funded plan, you will get some returns from that particular plan, that plan, fair value of plan assets. So basically what goes to your balance sheet will be your present value of defined benefit obligation as computed by the actuary minus your fair value of your plan assets. The net amount will go and sit in your balance sheet. What goes to your P&L account in the case of AS is going to be your current service cost, any interest cost because of the actual valuation requirements or actual valuation computation, because there could be an interest cost because of the funding or the provision for that particular gratuity, and any of the actual gains and losses in case of Ind AS, as I have already said, will go to your other comprehensive income, which is a separate statement. So it's not a separate statement. In the Indian Companies Act, it's a part of your P&L account, whereas abroad it's a separate statement. So this is only for the purpose of your presentation. Courtesy this notification of 10th of January, nothing has really changed. Nothing has really changed. But it gives rise to a few questions. We have now come to the conclusion that the insurance premium which you are going to pay is going to be based on your actual valuation. So you are going to say that first you get an actual valuation, then I will tell you. That's what LIC is trying to do. If any of you have not purchased LIC shares, please purchase it now. Because of two things. One is, they are forcing you to form a trust with them, as Aditya said. So number of contributions, LIC's balance sheet is already very, very large. This will only become larger. It's only going to become larger. The requirement for having a trust here, as Aditya has very rightly mentioned, and the fact that you will have to pay a premium for the trust. You will get an actual valuation done, and then they will tell you, okay, this is what the premium you have to pay. Let us say it is X amount of rupees. We get back to the classical accounting question. Please remember that this premium is actual valuation, means present value of defined benefit obligation over a period of time. Let us say 5 years. This insurance premium, would you expense it or show it as an asset? I leave it to you to decide. Because if you go to asset, then you should be present, you should have future economic benefits, you should have control, all those definitions will come into play. Expensive, even though it is a part of your, see, your basis is going to be future only. Your basis of the insurance premium is going to be based on what you are going to do with the discounting in the future. But if I go back to definition of an asset as per AS or even as per Ind AS, look at the control, power to control economic benefits, very difficult to justify the fact that it is an asset. Ideally speaking, whether you will claim an expenditure for this or not, that question directly you please ask Deepak. Whether he says 37, he is the master of the sections of the Income Tax Act, he says 37 bracket 1, 37 bracket Q, some section will get you the benefit, but this is the first thing which comes up. The second thing which will come up, and this is a very interesting thing, I am just raising this point here because Aditya did mention about this in his presentation. The primary responsibility to pay in case the employer does not pay rise on the insurance company is what he said. He also mentioned that in case the insurance company is not paying it, the employer has to pay it. What am I going to do in accounting now? I have two possibilities. I shall wait for LIC to say they are going to pay or not pay. The moment LIC says I am not going to pay, current obligation, past event, forget Ind AS 19 or AS 1915, Ind AS 37 or AS 29 will come into play, current obligation, past event, reliable estimate can be made, I can make a provision. The moment LIC says, I will not pay for whatever reason, technically he can, reject the policy, technically reject the claim, whatever it may be. The other option I have got is create a contingent liability. Possible obligation from past events. LIC may or may not pay. I know how they are. I will show it of contingent liability to be on the safer side. Today, just for the general, information of all the members in the audience here, today financial reporting means disclosure. Accounting is very simple, no problem. What is important is how do you disclose how you have accounted for it, or how you disclose how you have not accounted also. So to be on the safer side, can I just say that I don't know what LIC will do. All of you must have had expensive insurance claims. Has anybody here received a 100% insurance claim? And like, especially in a scheme like this, wherein it is new, it is fresh, LIC wants to only fill their balance sheet with, more trust, what you can say. So, I think if I look at the definition of a contingent liability as per AS 29, possible obligation from past event. What is the past event here? I have a scheme. I may have to pay for the scheme. LIC may not pay. Later on, as years go by, I can make an estimate. I can say 25% LIC has not paid, 75% I have made, I can make a reliable estimate, all those things. I am talking about year 1, which could be 31st March 2025. This is something we have to think of. The other aspect of accounting which could come out here, and I think this is something which will create a small issue, especially for the small and medium enterprises or those middle level companies which most of us are handling. If you look at the definition of control for consolidation, Aditya also mentioned that LIC is forcing us to, form a lot of trust. Let us assume I accept that. Let us assume I say, okay, I want this to, because then he said simple imprisonment for 3 months, he said. Simple or rigorous? Simple is okay, not problem. Rigorous only means problem. They'll ask us to do some, manual work in the jail there. Anyway, that apart, if I am creating a trust, apart from the challenges Aditya spoke about, I have to comply. I am scared, as Deepak also was saying, most of the people are saying that, we better comply, provision, we'll form trust and no problem. So we create a trust. The issue which comes up in accounting is, does the employer control the trust or not for the purpose of consolidation? I am not even looking at AS now. If I look at AS itself, it says that power to control the operating and financial policies. Power to change the majority of the board of directors, or whoever in this case probably could be the trustees. This challenge will come up because I am creating a trust here. Why am I creating a trust? Because of a statutory mandate. Legally I am obliged to create a trust, that's what LIC is trying to say, I have created the trust. Now do I control the trust, yes or no? If I control, I have to consolidate. Can I say, for example, that I will not put the trust monies in a mutual fund or whatever schemes? I can choose that also. I can choose what investment mode I make. If I choose operating, financial policies and personnel also, there is a very good possibility that we may also have to look at consolidation of the trust, both as per AS as well as per Ind AS. Of course, as per Ind AS, it becomes a little bit more, what you can say, easier, because Ind AS is subject to interpretation. Power to control the variable returns to the investor, they say. Nobody knows what that means. I've got power, I've got variable returns, do I control it? How much can I control, how much I get back from the trust? That becomes a very difficult question to answer. Why I am raising this question is because we got this problem of the definition of control, which is a little bit more loose or liberal in Ind AS, can I say, than in AS. In AS, I think the defining factor is going to be, of the gratuity trust, can I control the operating and financial policies? And when I say, when I am from the company's point of view, invariably the answer is going to be yes only. Because the trustees I can choose. My investment pattern I can choose. Remember that a gratuity trust is a cash flow issue also. It also depends on the cash flow of the entity. I have to plan my cash flows also accordingly. So, to a large extent, we can probably say that the employer will probably have power to control operating and financial policies, in which case consolidation will become mandatory as per AS. So, you'll have to consolidate the trust also. Many companies, large companies have already started doing this, they're already consolidating their trust, but again we have a challenge here because less than 500 employees, I did not have a trust. I only had a provision sitting in my books of account. Now I'm creating a trust. I have to consolidate also. And whether that, what you can say, whether the person is capable of doing a consolidation, whether a tally permits consolidation, this is maybe the first time I'm doing consolidation in my life at all these questions or these challenges will also come up. So I would probably think that this notification has given rise to the basic three problems here. Now, as far as the accounting itself is concerned, as I said, there's really nothing much we can do here because everything remains the same. The notification does not change the accounting pattern or the accounting entries we'll have to make. That does not change. But one of the things which is probably very important for us to understand is this, though it's not directly linked to the premium we are paying, is this beautiful concept of discounting rate, which all of us are familiar with. What is the discounting rate we apply for this? Would discounting rate change process insurance? Please remember, discounting rate also, insurance also is a cash flow for the entity. AS 15 says discounting rate for present value of defined benefit plans, similar language used in days also. And actually says, okay, whatever discounting rate is using, 7.85%, 7.9%, risk-free rate, whatever it is. That really does not change because of this notification here. But I think one of the things we need to remember is that because we are discounting future cash flows, and insurance can also be an annual cash flow. Please let us not forget that it's not a one-time insurance, it's not a one-time policy. It's not a one-time premium payment. This can be an annual cash flow. I may have to take that also into account for the purpose of deciding my discounting rate. That also may have to take into account for the purpose of discounting, for the purpose of deciding my discounting rate. I always mention this. What is the most popular discounting rate in India? Sir?
SBA rate.
SBA rate. See, he's not giving me a rate, he just said SBA rate. Let us say SBA rate is 7.53%. Whatever it is, some GOE T-bond rate is 6.53% or whatever it is. Let's say 7.53%. We add a risk premium because we are neither SBI nor are we Government of India. We add a risk premium to this. How much do we add? Some estimate you, doesn't matter.
2%.
Very good, sir. I wanted 2% only. I get 9.53%. How difficult is 0.953 on Excel? So what will I say now? My discounting is my risk premium is 2.57%. Why am I saying 2.57%? I want to bring it to 10%. Recently we had this, not an argument, but we had this discussion with somebody. They said that, why have we chosen 10%? And they started using all sorts of language, internal rate of return, cost of capital, all those things. So I told her that I've chosen 10% because it's very, very convenient. I actually mentioned this. And she said, oh, I understand that, but can you give me a small write-up because I require it for my documentation. Please remember, she's not disputing what I'm saying. She didn't dispute 10% at all. She said, give me a small write-up so that I want to keep it in my file saying that this is what you use as 10%. Documentation is the least of the problems here. That is not a problem at all. So this is basically the summary of the accounting aspects. Now, from a general point of view, and this is again from a point of view of year-end reporting, I think branch has also been doing some programs on this. I give you a couple of things which all of you all should definitely keep in mind. This is not particularly linked to the gratuity scheme or the notifications, but generally as such also, right? One is that this is a statute which is mandatory in Karnataka, and as Aditya has said, it is applicable to any other company which is not a branch, my subsidiary also. We are now very fond of taking this thing called as MRL. What is MRL? No, what does it say? I know what it means, but what it expands. What is MRL? Any mistakes which have been made is that of the company, any good points of the auditors. That's what MRL is basically trying to say. You are anyhow getting an MRL. My suggestion is, because this is a mandate as per this Karnataka government statute, please include this also as a part of your MRL. Whatever it may be, it could be the insurance premium, it could be the creation of a trust, it could be whatever it may be. Please include this, because by not doing this, you are probably violating a law. You are not aware what decision the company is taking. So therefore, in your MRL itself or representation letter itself, put in a small paragraph drawing reference to this particular notification and say that we have complied with this as per the requirements of this particular act. I would also like to draw attention of members to what is called as NOCLAR provisions in the Code of Ethics. Code of Ethics, 3 volumes, all of you know that very well now. Code of Ethics now exceeds accounting standards in terms of number of pages. AS will have 700 pages, Code of Ethics about 720 pages, including all your case laws and all those things. A very good introduction is NOCLAR provisions. Non-compliance of laws and regulations. Straight away I'll ask audit committee, please include this in your audit committee meeting. Compliance with this Karnataka Gratuity Provisions Act, or whatever that act is called. I will straight away tell the audit committee, please include this, because if you are not following this, the CFO, management of the company can be held responsible for under the Code of Ethics. One of the best things which the Code of Ethics has done is to include them also under this particular branch. So I will definitely say that this is a requirement. See, as Aditya was mentioning, interpreting the law we can do any manner we want. That we can do, whether it's mandatory for below 500 people, 50 people, 20 people, we do not know that. It is not our job also. If the company has taken a decision not to form a gratuity trust, even though LIC has said so, and simply contributed a premium to some other insurance company, it could technically be a non-compliance. We are not aware of it. Please inform the audit committee that there is something called as NOCLAR. This comes straight away under NOCLAR. Please pass a resolution saying that we will comply with the requirements of this particular Insurance Premium Act or whatever the act is called. It is required because today we are in a situation wherein, sir was mentioning, when you sign an audit report, first of all we have asked, should we sign audit report now? It's come to that stage. Because everybody is trying to find faults in what we are doing. It can be SEBI, it can be NFRA, it can be MCA, it can be Serious Fraud Investigation Office, it can be... I had recently been to I was also speaking this NFRA international conference which was held last time in Delhi. I spoke to somebody from SEBI there. And he was just talking casually, and SEBI also has got something called as a compliance department, wherein they also look at what possible violations are being done by auditors and companies. I told him we should probably change the order, sir, because first company, then the only auditor comes in. He said, yeah, I agree what you're saying, first company only does it. But he was telling me of a very, very unfortunate incident which I thought I should bring the attention of all the members here. Some company in Rajkot or something was telling me this. SEBI got some information about some circular trading of funds or whatever it may be. And normally what SEBI does is that as a part of their normal practice, they call the promoter of the company first. Inquire from the promoters, the company, management and all, make their notes, and then if required, call the auditors, call the lawyers, everybody. This time SEBI said that let's change the pattern. We'll call the auditor first. Let us see what he has to say. Then we'll call the management next. So the auditor was there, he was called, he was summoned, then he said, "You have got some news about circular trading." Auditor was very, very clear in his response. He said, "Sir, this is not a part of my job. Please look at my audit report. Reasonable assurance, compliance with accounting standards. Circular trading is not a part of my job at all." He was very clear in his response. And then SEBI asked him, "Okay, have you been going for all the company's audit committee meetings?" And he said, "Yeah, sir, every year 4 meetings held, sir, regularly. I'm going, sir." SEBI made a note of all these things and thought, okay, auditor is obviously not responsible for this. He is not aware of this. He said, was any of this discussed in the circular in the audit committee meetings? He said nothing was discussed. Okay, auditor was let go. They also asked him, how did you go for audit committee meetings? He said, I went by car, he said. That also he mentioned. SEBI sometimes, when they go into this forensic mode, they ask these questions. After a month, they called the promoter and asked him that, we've got news of circular trading. He said, no sir, I don't know what circular trading is, sir. He doesn't, for a company what no audit report now. He doesn't have any audit report, only what they do in NDA only. As the investigation progressed, SEBI told the company that we met our auditor 15 days back. Auditor said that all audit committee meetings he has attended. The company chairman seemed to be surprised. He said, did he say that? He said, yeah, he said that. He said, why are you so surprised? The promoter said, sir, I tell you very frankly, no audit committee meeting was held. Minutes we did only about 15 days back, only for your purpose. There was no audit committee held at all, he said. Now SEBI was in this classical dilemma, whom to charge here, company or the auditor. That's why they asked him, how did you go? I went by car, he said, because he can't ask for plane ticket, no. They can't ask for evidence, right? But what the SEBI person told me, to cut a long story short, he said that apart from the fact that this man came and told us that he is one for audit committee meeting, no, we do not know why he said that. Subsequent investigation proved that what the promoter said, the promoter was anyway caught. The promoter was anyway caught. So he said that when the audit committee meetings were made up, auditor was called for at least before SEBI, you should disclose all the facts properly. This, we're just talking in a general mode, but I'm not trying to say that any of us are going to do this for any of our clients, but the focus today should become on appropriate and accurate disclosures. This is just one law. We can have so many other laws which come in. For us, there are two things we have to remember. Disclosure in the financial statements and, at the cost of repetition, I will say, documentation. We have to document every single possible thing. I do mention this wherever I go. I did not think that a day would come when I have to use the word called defending the audit. But today we have come to a stage wherein we have to defend our audit. It need not be SEBI, it need not be RPA, it need not be NFRA, it need not be anybody else. It can be our own institute itself. The peer review mechanism is going to increase now. They are going to take probably a lesser rigid stance than NFRA, but the documentation requirements are not going to reduce. You look at the QRB. The QRB person tells me that my documentation will take me 3 days. His documentation, not your documentation. His QRB documentation is going to take him 3 days. Then he has to come to your office and review your documentation. Minimum 7 days has to be spent at the place. Anyway, so that was beside the point. What I thought I should tell you all is that no clear provisions, so just to summarize this notification, no change in accounting, AS or Ind AS, insurance premium, please expense it. Your gratuity valuation report, actual valuation report, nothing is going to change. Presentation also does not change, both in AS as well as Ind AS. The thing we'll have to think about is going to be, in case the entity becomes responsible or liable to make a payment for a failure of the insurer, whether we have to create a liability or a contingent liability, or create a contingent liability and pass it on to liability in the event of a non-payment. This would be a better route to take because at least it is there. At least it is there. And the last point which I thought I should mention is, because it's a statutory provision, please include it as a part of your MRL and tell the audit committee to include this as a part of that non-clear provisions. So this is what I wanted to say. Thank you very much. We'll open the forum for questions. Thank you. Any questions? Please stand up, ask us questions, and you can tell to whom the question directed also. Forty minutes is left for questions.
This MRL starts with the bank audit itself, sir. This upcoming.
Yeah, of course, yeah. You should do it in the bank audit.
It's applicable only for Canara Bank and other PSUs is not applicable.
Sabi banks are all the banks. Please do it for all the banks.
Because head office is not Bangalore.
But you can get it any which way. You can get it by email. So what is it?
Good evening, Aditya. The question is to you. Basically, the notification talks of employer-employee throughout. What if in a scenario we have a holding company and we have this group gratuity insurance where all the subsidiaries are also covered as part of the trust of the holding company. So would that still be compliant for the group companies, the subsidiaries?
Simply put, yes, because you already have the trust.
Okay, so what about going forward?
So going forward, it's a little more complicated. The rules require you to form a trust for your employees.
Okay, so it will have to be an individual trust for each of the companies.
Correct.
So it cannot be part of the group.
It's going to be harder to sell that
Okay.
once post 10th of January.
Okay. Yeah. Thank you.
Yes, hi. This is a question for Deepak sir. So, basically, if from the company's end, the money is directly going to the insurance company and not to the trust, is the contribution allowed under any section?
Do you have a trust in place or no?
No.
So if there is a direct payment, that would fall under 40A9, payment to an unapproved gratuity fund. So at the time of contribution, it is to be disallowed. But at the point of final payment to the employee, at that point of time, it will have to be allowed distribution.
Okay, because right now, so a lot of companies, they do not want to make a trust because it's extra compliance. Not maybe return filing, it's not mandatory like you said, but auditing of the trust and maintenance, bank account, all of that. So a lot of companies are not going through that and they want to invest directly into the insurance fund. So the entire fund amount that they are keeping aside now and investing into the funds wouldn't be allowed, right? For the
I presume none of these funds have any approval from the department. That is what my inquiries tell me. And logically also it is not possible because the Act envisages a separate trust for every employer. Unless they have a separate pool for every collection that they make, which is also not the case that we discussed in the evening. So that will be disallowed. So it's just creating a timing difference. It's not that you want to lose out on the benefit forever. Instead of getting a deduction in the year of contribution, your deduction is going to be deferred to the year of ultimate payment to the employer. So it's just a matter of time and not a permanent disallowance in that sense.
correct, but also one more thing additional to that. These are all irrevocable funds where you can't pull out the money. So if these employees leave before 5 years or say 3 years, the amount, okay, now when I am investing into the funds, it is coming, it depends on the actual valuation that I get. If it is for 10 lakhs, I'll invest 10 lakhs. But now if 1 or 2 employees leave before 5 years, the gratuity will never be payable to them and it will be sitting in that fund and it's irrevocable. I cannot even take it back. So in that case, how will that allowance happen?
In that event, you will lose out on profit.
I also have a question to you, more to add to that. So, the contributions made by the company to an insurance provider ultimately pays the employee. As a company, where do I get the tax money?
So the payment happens from the insurance provider to the employee. It's a payment on my behalf, made to the employee. I'll have to keep a tab of it and I'll have to claim it in my income confession.
Thank you.
I think in the subsequent case, if that employee is not paid, subsequent premium will get down, reduced. Right?
That's what the supposed to be. Yeah, that's what they indicated. They said they would adjust premium based on your actuals for the next year.
I have a couple of questions. First to Mr. Lavi. So you said that if the company has a branch in more than outside Karnataka, then these rules are not applicable. So what documentation employer can have to substantiate that there is a branch? Is a GST certificate enough, or there has to be a shops and establishment registration for the branch?
So from a evidence standpoint, a GST certification may suffice.
Okay.
However, if further evidence is sought upon issuance of a notice, you have to establish that it's a branch. Because the GST alone does not establish that it's a branch. So through your accounting, you're going to have to show that there is no independence or an independent existence, whereas you're the ones who are funding these branches.
So if I do not have a GST registration, would the shops and establishment registration would suffice?
Any license issued by a government authority to establish that there is a physical branch in another location.
Okay. So you also mentioned that if the trust is already in existence, it may not be required to go and register with the registrar of trusts. Whereas the rule specifically indicates that the trust has to be registered with the registrar of trusts. So what kind of challenges you foresee practically if we go for the registration of the trust with the registrar?
No, there are no challenges if you choose to do it.
Okay.
Voluntarily, you are the one choosing to go and register the trust, and then the only issue that we have now is time, right? Because this mic I think is very well. So that issue, to overcome the issue of time, you can choose to first comply with these rules and then proceed to go with the registrar of trusts if you want to do that. That should not be a challenge.
So any compliances required when I register with the registrar of trusts? Any annual compliances or any?
Nothing. It's a registration process like any other. All compliance or rather whatever you need to do happens at the time of registration.
Okay. And this 20 lakhs gratuity limit, the cap, what the Income Tax Act says that it's a lifetime exemption granted. But whereas gratuity does not say that the 20 lakhs is the limit for the lifetime. So is it applicable per employer, this 20 lakhs cap?
So the lifetime cap, like Deepak clarified, is when you go to 10.10.3, which is a scheme outside of the Gratuity Act. It does not apply to a scheme under the Gratuity Act. Under the Gratuity Act, it's not a lifetime cap, it's a transaction cap.
Okay. So is it so, Deepak? Can you?
So the proviso applies only to clause 3 and not to clause 1 and 2.
Okay. So 20 lakhs exemption is applicable per employer if I am covered under the Gratuity Act. So now, Deepak, one question. See, this text tool decision, the principle laid out by the Supreme Court in text tool decision is because the fund was irrevocable and the employer does not have a recourse to the funds, even though the funds have been directly contributed to the fund without routing it through trust, the deduction was allowed, right?
But
So
the key fact over there is there was a fund and the payment was made on behalf of the fund. So if you're trying to extend this to a scenario where there is no fund and I'm making a direct payment, I think that would be stretching it too much.
No, my question is, see, LIC is giving the gratuity fund management facility without having the trust, provided the number of employees are less than 500. But there also it is an irrevocable fund. Once I make the contribution, I won't be able to, I won't have recourse to the fund. So if I do not have the trust, if I take the direct LIC policy and I fund it, my gratuity liability, will the deduction be allowed?
There is no approved fund, you don't get a deduction. It will have to be disallowed at a 48.
No, but LIC says that it is approved.
So that's the key here. Are you following the approval mechanism? Are you taking your fund to the commissioner and getting it approved? If yes, then your approved fund, no disallowance. If no,
so even if there is no trust, if it is an approved fund, it is allowed, is what you are saying.
Approved fund is a trust registered with the commissioner. Sir, on the consolidation part, where you said that
trust accounts may need to be consolidated. You said two conditions. One is trustees can be chosen by the company. But when you look at the new rules, it says there has to be employees also who are part of the trust, who are trustees basically. If I have a labor union, union may appoint the employees who are going to be trustees. So in that case, assuming 50% employer representatives and 50% are labor union trustees, do you still say that I have a control over them?
I would still think that this concept of control you have to demonstrate. Right? You have to demonstrate it. Whether you have a union or not is a different issue. See, this unfortunately, this concept of control has now come to a stage wherein, say for example, I can choose who in the union is going to become a trustee.
I can choose.
I can choose who in the union is going to become a trustee.
Okay. Is it so? When union will have.
In fact, union has no power to appoint trustees. The company is the only one, because the trust is not formed by the union. Trust is formed by the company.
Okay.
He's only a representative of the union. So I would still say, yeah, I think we still have control, and therefore it's demonstrable control, therefore we have to demonstrate.
Okay. And investments also are prescribed by the income tax if it is an approved fund. So where can the company has a right to choose the investments? Does it have a control on the investments then?
No, investment is only one part of it. No.
Okay.
Investment is only one part of it.
So on a larger picture.
Provided sector, within the sector.
Within the sector they can choose, no.
Within the sector I can choose.
Yeah.
Within the sector I can choose, but not the entire.
Yeah, but that still gives you an option to choose, right? I still have the power to control.
Okay. So what is your message now? See, as a statutory auditor, if I have to certify the financials and issue the report, and the company is not following the rules, they do not have a funded gratuity. So what precautions I need to take?
Okay, so my first thing is, if they are not following this, please report it in your audit report.
Report in the audit report?
Please report it in your audit report.
Okay.
You may not be the auditor for the subsequent year, but I always do mention this, but please understand that in this present day and age, this risk-reward relationship is becoming very, very critical. If the reward is less and the risk is high, please mention the audit report, very, very important.
Yeah.
Where you want to mention, there are a lot of paragraphs.
Okay.
You can put EOM, you can put KAM, you can put it in other matters, whatever you want, you can put it. But please ensure that somewhere it is there in your audit report, not in the notes and accounts.
Can I fall back on the writ petition, because it is an impossibility of performance. So since already a writ petition is filed in the High Court, I
am going to file a writ petition against Aditya's writ petition. What do you have to say?
So, I only wish life was so easy and I find something and I can take reward for it. Unfortunately not. It's not.
But I would advise you to be a little bit more, in this case, typical case where you are saying this there. So, why I am saying audit report is because the concept of disclosing notes of accounts and taking reference shelter somewhere I will disclose it is not available. That's why I said defending the audit. Defending the audit is not notes and accounts, audit report.
Thank you. Thank you.
Good evening, sir. This is a question to Aditya. So, can you please elaborate about this manpower contract service impact on this? Because the manpower service provider, normally what he says, the employee will be same and only the contractor will be keep changing. And the principal employer says, it's not my duty. So, the contractor or the staff who is the manpower agency has to take. So, in this rule, how it takes place and the impact on it.
So specifically in relation to gratuity, we have a Madras High Court ruling which is affirmed by the Supreme Court, which says that the contractor shall be principally liable to pay gratuity. The liability does not fall back on the principal employer. However, every manpower contractor bills the principal employer typically for gratuity on a monthly basis. It's talking about the 4.32% rate. So as a compliance requirement, every principal employer should ensure that the manpower service provider now either has gratuity insurance or has formed a trust. Because ultimately that liability will come back to bite him because they are billing him for it, and lots of times that money does not get paid because this is the high risk segment. there is a lot of churn, there is a lot of attrition, but at the same time, compliance standards are not always the highest. Any contract labor, manpower or otherwise. So from a principal employer standpoint, you must start insisting that if they have more than 10 employees, either form a trust or get insurance.
What if from the manpower service provider, the contractor?
It is safer for them as well because it's funded by the principal employer. I am billing the principal employer and I am getting the money on a monthly basis. For me to contribute that premium is much simpler. And it also poses a challenge because as a manpower service provider, I have one employee who has completed 5 years of service across 3 different principal employers. So certainly I am going to be hit with that liability of gratuity, which I may have accounted for in my books, but I may not have. So this insurance that will safeguard.
Sir, question to Mohan sir. Sir, creating this contingent liability we discussed with the insurance company denying payment. Primary liabilities of employer only. Insurance is only guarantor. So my liability is always there. Why one more contingent liability?
So you're saying create it as a liability itself, not as a contingent liability?
I believe so, sir.
No, I'm just saying that. See, this is only a possibility which I thought of. You will not be getting anything from the insurance company.
Yes.
It's going to be a yes or a no.
Yeah.
Right. So if I look at the definition of this word called as present obligation for AS 29 compliance, I'm not worried about 19 right now. I'm talking about AS 27 or AS 15. I don't have an obligation today, sir. I don't have a current obligation. Past event is there, but I don't have an obligation. It's only a possible obligation. That is why I'm saying contingent liability. But as I said, as we move along and we get history of number of cases rejected, how much has been rejected and all, I can make a more reliable estimate. In this year, I'll show it as contingent liability.
So just wanted to add that there are some things that are not, while we have everything in black and white in the rules, labor laws like many other laws don't tie together. Right? So for example, we have the Standing Orders Act in Karnataka which says a fixed term employee, no matter what the term is, if he completes 1 year, he is eligible for gratuity. Now that liability is not under the payment of gratuity act. It's a distinct liability. Now if I do take a policy, LIC is not going to pay for this 1 year employee because that coverage is only under the payment of gratuity act.
But I still have to create a provision.
Now what do I do about these fixed term employees? So you are going to have variables like these which you are going to need to factor in.
So what happens in manpower outsourcing? For the company, the employee is working for 5 years, but 3 agencies got shifted. What happens to the principal employer?
So, the question here is who's the employer and who's the principal employer. Now, Contract Labour Act makes it very clear that the contractor is the employer. He may pass on the cost to the principal employer, but the liability to pay is his. So, in manpower companies, that's why we say you ensure that you bill the principal employer for gratuity at one of 2 times. Either you bill him on a monthly basis or you bill him at the time of the exit of the employee, irrespective of whether it is 1 month or 1 year. Now the principal employer, how does he account for it? It's just a cost, it's not salary or pay cost of them.
There's an interesting question that had come up in the tea break. Now, I have all along been a company who's simply made a provision in my books towards gratuity and there's a liability of, let's say, a crore sitting in my balance sheet. Now, subsequent to these rules getting introduced, I decide to set up a trust and this 1 crore in my liability is now funded and I make a payment to the trust. Historically, this 1 crore has never been allowed to me as a deduction. Under 47, it is being disallowed. Now, what is the fate of 1 crore which I have now paid to the trust? Where do I get deduction for it? Or do I at all get a deduction for it? Here 3615 should come to your rescue to say contribution to an approved gratuity fund, you should be in a position to claim the entire 1 crore as deduction in the year of contribution to the approved fund.
I just had a thought related to the previous question. Now this, the gratuity insurance is mandated in the Gratuity Act. You just said you have to invest the funds into a gratuity insurance fund. There's nowhere mention of a trust. So can we not claim the deduction under section 37 saying it's a business expense? Whatever.
37 gives you deduction for it. No disputes on that. As I said, there is Karnataka High Court in the case of Mysore Tobacco Company, which says if the provision is made on a scientific basis, mere provision will give you a deduction. Forget about even making a contribution. But then that deduction is subject to test of disturbances. So you will get caught under 47 and 49. I am not disputing its allowability under 37, allowed. But under 49, disallowed. So your thought process on 37 is absolutely right. You also have to apply 49 to it.
Not supersede 48 is what he says.
We will
So
see something
the
that
30 to 36 or 30 to 37 allowances are subject to disallowances.
okay, so okay, got it.
Assuming there are no more questions at least. Because they're completed.
All the questions have been clarified. Just hope you got an enlightening session with all the three experts on the matter from three different aspects. So I thank wholeheartedly all the three speakers for taking your time out and then addressing us. I request our chairman to hand over a moment of appreciation to all the three speakers. Can we have a big round of applause for all the speakers, please? Thank you, Aditya, for taking your time out. Once again, I thank all the speakers for, on behalf of Bengaluru branch, thank you so much. Members, thank you for your active participation and also asking all your questions. Hope all the questions are clarified. In case if there are anything, you can write to us and we will forward it to the respective experts and get you those clarifications. Thank you. Good night.